are wondering if they should invest in stocks and ETFs now or if it's matter to wait. So today I thought it would be interesting to dive into this question that is on every investor's mind, especially new investors, due to the news that is flying around. Hey everyone, if you're new here, my name is Comfort. I'm an investor, and here I talk about personal finance, I talk about personal development and investment. So today we're going to unpack what is happening in the market right now. We're going to be looking at major signals. I'll be sharing what this means for us as investors, and I'm going to be walking you through a practical step you can follow. So let's dive in. Let's see where the market is at the time I filmed this video and why there's so much talk on this now. So from the US indices, the three major indices, which are the S&P 500, the Nasdaq Composite, and the Dow Jones Industrial Average, has hit a record high this period on stock market. Example, the Dow Jones closed at $47,000 for the first time ever, and this is because the much awaited inflation rate report came in cooler than was predicted. It was predicted to be 3.1% but it came in at 3.0%. So because inflation is one of the major factors that affects the stock market, when inflation is very high, those companies that are facing rising costs may struggle to maintain profit, and this may lead to stock market being impacted and also leading to volatility, which will definitely cause stock prices to fluctuate. Also, high inflation can lead to economic slowdown because people will reduce the way they spend money, and this can negatively impact stock performance. But that is not the case right now. Inflation data is slightly cooler now, and this is the likelihood that the American Central Bank may cut interest rates or at least not raise them further, and this will definitely help stocks. With that being said, there's talk now about possible bubble in AI related stocks, but that's not what this video is all about. Okay, if you're new in investing, here is something you should know. Stock market investing comes with lots of emotions, so you need emotional discipline. You need to prepare your mind emotionally. This is not to scare you, but like to prepare you so you don't get overly scared or overly excited when the market goes up and down. So here comes the question. Should you invest in stocks now or wait? My answer to that question is this. I am actively investing and I think you should do so. And here are my reasons. Number one, investing remains a powerful tool to creating financial freedom. I cannot overemphasize that. The truth is that you can never save your way to financial freedom because of inflation. Your savings account gives you about 1% in interest rate, while inflation is way higher. So your money loses value. But on the other hand, your investment gives you about 8 to 10% returns every year, and that's the average. Sometimes it's even higher than 10%. So you see, investing is the only tool to withstanding inflation. Now, here are practical steps you can take to act wisely. Number one, define your investment goal and your time horizon. What I mean by that is, ask yourself what you're investing for. Are you investing to buy a house, or are you investing for your retirement, or you're just investing to build wealth? When you answer these questions, it's going to help you to know the time you're likely going to need the money. Let's say, for example, you're investing to buy a house. You already know that maybe in the next 2 years or 3 years, you're going to be needing this money. But if you have like a long time, like between 10 to 20 years, that means the more risk you can tolerate in investing. But if you're going to be needing the money sooner, maybe like the one for buying a house or even maybe for retirement, and you're already close to retirement, you may want to be cautious and use conservative approach of investing by investing in bonds and ETFs. Don't chase the hottest stock or the next AI stock, thinking that you will blow overnight. And if you're totally new in investing, I recommend you start small. Don't put in a lump sum of money. The second step is consider investing in ETFs rather than single stocks. The reason is because ETFs has dozens or thousands of companies stock in one. So you own tiny pieces of stocks of different companies. And the benefit is that all these dozens or thousands of companies will not be doing badly at the same time. So the ones that are doing badly, the ones doing well will cover up for the ones that are doing badly. at any point in time. So your returns is somehow, sure. So when it comes to ETFs, it's also good for you to invest in dividend ETFs so that, that monthly or quarterly payment of dividends also helps your portfolio to grow. Another thing you should also consider is to, diversify your portfolio by investing in both local, international, and US markets. Next thing you need to do is you need to allocate how your portfolio is going to be. And when you choose it, you have to stick to it. You can choose 80% of your portfolio to be ETFs, and you should be diversified, like I mentioned earlier. And then 20% of your portfolio can be individual stocks, as if you like stocks. And please make sure to research any stock before buying. And if you would like to know how to research a stock before buying, please check this video. It's well explanatory. Next step is to use what is called dollar cost averaging. Dollar cost averaging is the secret strategy of any successful investor. What this means is that they invest both during market crash and when the market is up, especially if you're investing for a long term. When you keep investing consistently, even when there's a market crash, what happens is that during the crash, you get more funds because you're consistent. Let's say you made a decision to be investing $1,000, or let me say $500 every month, which is going to be our next step I'm going to discuss. Now, when you keep investing that $500 every month, during market crash, that $500 could get you more funds than when the market is high. Okay, let's say that the ETF is $20 when the market was up. So with $500, you could get 25 ETFs. Now, let's say when the market crashes, the ETF was about, let's say, $15. If you consistently invest that $500, during that market crash, that $500 will be able to get you about 33 stocks. You see, that's more funds. Now, in the history of stock markets, there has never been a crash that doesn't recover. And when it recovers aggressively. That is, the market goes up high. So this is how successful investors make their money. During this market crash, they keep on buying. And when the market recovers, due to the fact that they now have more funds, that is how they make their money. So you need to set up an automatic transfer of any amount of your choice every month from your checking account to your brokerage account to buy ETFs. And please, if you don't know what a brokerage account is, please drop it in the comment section. I will definitely reply you. So when you automate this transfer every month, it's going to help you to take away, emotions out of the equation and help you to consistently invest every month, which is recommendable when it comes to investing in order to build wealth. Now, next thing you need to do is to prepare and plan for, market pullbacks, because that is how stock market is. It goes up and it comes down. If you see market pullbacks, please do not panic sell, because when you do, you will lose. But if you're new to investing, I get it. But this is something you should know. You have to see that market dip as an opportunity to buy more. Remember what I just explained about dollar cost averaging? Yes. So next thing you should do is to review your portfolio every 3 or 6 months to make sure that you're still aligned with your investment goal. Because remember our first step, we were able to, define our investment goal and our time horizon. That is when we need the money. So make sure that your portfolio is still in alignment with your investment goal of maybe investing to buy a house, or investing for retirement, or investing to just build wealth. And try not to make major changes on your portfolio due to maybe fear or news headlines. So in summary, it is a no-brainer to start investing if you haven't started, and to continue investing if you have started. Because the truth is that investing remains a powerful tool to building financial freedom, not savings. Please, if you find this video helpful, can you please hit the like button and subscribe if you haven't? It is absolutely free and it's going to help me to build this channel. Thank you so much. Now, let me ask a question. What is your biggest question in investing right now? Please drop it in the comment section. Thank you all so much for watching my video, and I will see you in my next one.